Silver Trust or SLV?
And it's posing a very, very pointed question.
It really is. We're looking at a stack of your sources that all seem to be asking, is this the moment? Is this the, quote, last chance below $70 before silver kicks off a new commodity supercycle?
It's an intensely bullish position.
Uh-huh.
I mean, the source material you provided, it doesn't mince words at all.
Not at all.
They're arguing that what we're seeing right now is basically a closing window for investors to accumulate the asset before a really big structural price spike.
So our mission today is to unpack that sense of urgency. We're going to dissect the technical triggers and the powerful fundamental drivers that this analysis is pointing to.
And these drivers, they claim, point toward massive appreciation. They're even using phrases like triple-digit territory by 2026.
And that urgency, it really comes from what just happened. I mean, just yesterday, SLV made a huge move.
Huge.
It surged, what, 4.5% in a single session?
Right. And it wasn't a subtle move either. It was a major test of conviction that saw the price just slice right through that critical $70 psychological ceiling.
Even if only for a moment, it created some instant drama on the charts.
And that move is really the genesis of this entire thesis. For anyone who's been waiting for confirmation that this market is serious, well, that aggressive break is it.
So if this analysis is right, any price below 70 is basically history.
That's the argument. The report gives us a kind of roadmap, suggesting the price action and the fundamentals are, for the first time in a while, perfectly aligned.
Okay, let's unpack this. Let's start with the technical side, the chart action that gave the report its title.
A drama, yeah.
The drama on the chart. It peaked when SLV hit an intraday high of, what was it, $70.76?
70.76.
But then, as you often see when you challenge a major resistance level, it pulled back. It settled a bit lower, closing at $68.98.
It still added nearly $3 to the share price in one day, which is massive. But that failure to hold 70 is the key question. How does the analysis read that?
Right.
And this is where chart analysis gets interesting. Most retail traders, they see it peak at 70.76 and then close below 69, and they might think, okay, the move failed. Resistance held.
That would be the immediate assumption, yeah.
But the analysis argues the complete opposite. It frames that slight pullback as profoundly bullish.
Okay, but why? I mean, if it couldn't hold that $70 level after putting all that energy into breaking it, isn't that a sign of weakness? Maybe even institutions selling into the rally?
Not according to the patterns they're citing. The report identifies this exact action, a strong, almost vertical move up, followed by a shallow, high-level consolidation as a textbook bullish flag pattern.
Okay, a flag pattern.
The sharp surge is the pull, and this mild, contained pullback is the flag itself. It's seen as momentum just pausing to gather steam.
So, not weakness. A rest stop.
A rest stop before the next leg up. And crucially, the sources describe this dip to 68.98 as the final opportunity to get in before that next, potentially much more powerful move begins.
So the analysis is telling you to actively embrace this little dip, to see it as a gift, not a warning sign.
That's it, exactly.
And what's the larger technical picture here? What are they framing this little flag pattern inside of?
They place it within an even larger multi-year setup. The classic cup and handle breakout formation.
A huge pattern.
It's a massive long-term pattern that signals a fundamental structural change in a market, something far beyond short-term noise. The brooch of $70 signals that the whole pattern is now complete.
So when the price settles back into that $68 to $69 range...
That range, according to the analysis, isn't just a temporary dip. It is fundamentally becoming the new floor of support for SLV.
And that shift in sentiment is everything, right? Moving from a ceiling you couldn't break to a new floor you can bounce off of.
Precisely.
What's fascinating here is the report spends a lot of time on the sheer volume that was recorded during that breakout. They really stress that this wasn't just, retail traders getting excited.
And that institutional context is absolutely essential. It's validation. Big money, the institutions, they need time and liquidity to build their positions.
Right.
So when you see an aggressive move like that, and it's backed by massive volume, it tells you that the smart money is moving in. They're building their exposure.
So the analysis suggests that those big players actually used that little pullback, the flag, to finish buying.
To finish their accumulation, yes. And that lends tremendous weight to the idea that the $68 to $69 region is a confirmed anchor point. It's not a weak spot. It's the institutional seal of approval on the breakout.
So we have the lines on the chart confirmed by institutional money flow. Here's where it gets really interesting. Let's talk about the engine. What is fundamentally powering this? Because the report argues we are walking straight into a perfect storm.
The fundamentals, yeah. The convergence of these drivers is what really elevates this whole thesis beyond just a simple chart read. They identify three major pressure points all converging at the same time.
And that's what they're calling the super cycle.
That's the setup for it, yeah.
Okay, let's start with the most basic one. Supply. Driver number one is just the harsh reality that the market is physically running out of silver.
It is. The analysis highlights that we are now entering the sixth consecutive year of a silver supply deficit.
Sixth year.
Sixth year. This isn't just a minor shortfall. It means global consumption has outpaced what the mines can produce every single year for half a decade. We are draining global stockpiles.
And this is a structural problem, right? It's not something you can just fix quickly.
It's completely structural. Silver mining is incredibly capital intensive. New projects have these really long lead times. So even if the price skyrockets tomorrow, it takes years, not months, to bring any significant new supply online.
Which supports higher prices for a long, long time.
Exactly. That rigidity is fundamental.
Okay, so you have that supply problem, and then you're compounding it with driver number two, which is just an unprecedented rate of consumption. Massive industrial demand.
And this is maybe the most modern and frankly compelling part of the whole argument.
Yeah.
The analysis points directly to the demand explosion from these high-growth tech sectors.
Right.
Silver is just irreplaceable in a lot of these applications because of its conductivity, its resilience. They specifically name the huge infrastructure build-outs needed for AI hardware.
Things like data centers, specialized chips.
All of it. And the accelerating global pivot to green energy, especially solar panels.
And solar is just huge for silver demand, isn't it? Every single panel needs it.
Precisely. Every panel needs silver paste for conductivity. The amount of silver required to meet the world's aggressive solar goals is just... it's astronomical.
So AI and green tech are consuming silver at record rates.
And the analysis says this is what's driving the reported depletion of all the above-ground inventory. This creates maximum upward pressure because, unlike gold, a lot of the silver that's used in industry is basically gone forever. It's destroyed, or it's just not economical to recycle.
It's truly consumed.
It's gone from the available market.
So you've got a commodity that's essential for the future of AI and green energy, and it's becoming structurally scarce. That's a powerful conflict.
A very powerful conflict.
But then there's the third driver, which connects all of this to the global financial picture.
Yeah.
The anticipated Fed pivot.
This is what links the physical scarcity story to the macroeconomy. The analysis is built on the expectation that the Federal Reserve is going to start cutting interest rates.
And the report is pretty specific, right? They're forecasting cuts on the horizon for January 2026.
They are. And this matters so much because lower rates systematically weaken the U.S. dollar.
Which is a huge tailwind for commodities.
A massive tailwind for hard assets like silver, which are priced in dollars.
Okay, but historically, yes, that relationship holds. But the report is entirely bullish. What's the risk here? What if the Fed doesn't pivot? Or they just delay cuts?
That's a crucial question. And the analysis does acknowledge that if inflation were to spike again or the economy overheats, the Fed could hold rates higher for longer.
Right.
However, their core argument is that the escalating global debt situation and slowing growth will eventually force the Fed's hand, probably by early 2026, regardless of any short-term noise.
So they see the pivot as almost inevitable.
They're relying on that historical inverse relationship, high debt, low real rates. That's the environment where commodities, especially scarce ones, begin their strongest rallies.
So when you combine that rigid physical scarcity, the supply and demand squeeze, with a monetary forecast that pushes investors away from the dollar.
That is the definition of a commodity supercycle beginning, according to these sources. It's a powerful, synchronized triple whammy.
Technical breakout, structural supply deficit, and a turbocharge from monetary policy. So now that we understand the drivers, what's the action plan here? The report's central argument is this real sense of urgency.
It is. That the window to buy SLV in the $60 range is closing fast.
The message is pretty direct. Anything under $70 is defined as a gift.
A gift, yes.
Yeah.
And the strategy they advocate for is to practice buy the dip conviction. They really emphasize that the current volatility, that pullback from over $70 down to $68.98, that's not a reason to be shaken out.
That's your entry point.
That is your optimal strategic entry point.
That requires some real trust in the pattern, though. You have to ignore the day-to-day noise and trust that institutional volume is going to resolve this thing upwards.
Exactly. The focus has to be on the long-term structure. And that structure leads us to their price targets.
Okay, so what are the immediate confirmation triggers they're watching for right now?
The report lays out very specific levels. First, the market needs to get a clean daily close above $70.50.
70.50. Why is that the magic number?
That threshold is critical because it confirms that the $70 psychological feeling is truly shattered. It's been successfully converted into a new support level.
It signals the transition is complete.
The technical transition, yes.
Right.
And once that happens, the analysis identifies the next major resistance level, the immediate target, at $75.
75, the first major hurdle.
The first hurdle for this new leg up.
And if we look further out, towards that 2026 supercycle potential. What are the price projections there?
The long game is where it gets really big. The analysis cites a growing consensus among analysts that the underlying physical silver metal will trade above $100 an ounce.
$100.
And the report extrapolates from that. Based on the ETF structure, if the commodity hits that $100+ mark, SLV will realistically be trading well over $90 a share.
Wow.
That's the scale of the multi-year triple-digit supercycle they are predicting.
So if that forecast holds, the current price in the high 60s really does look like a phenomenal risk-to-reward scenario. So what does this all mean for the person listening right now? What's the final takeaway?
The analysis concludes, pretty bluntly, that the risk-to-reward ratio here is possibly the best in the entire market right now.
That's a strong statement.
It's a very strong statement. But given the multi-year deficit, the insane industrial demand, and the institutional validation of the technical move, they see the probability of sustained upside as being extremely high.
It's that convergence again. The technical confirmation matched with that powerful fundamental story.
That's what gives it conviction. The message is really simple. The window for accumulation, especially below 70, is now viewed as extremely limited.
If we connect this to the bigger picture, the most profound implication here seems to rest on those industrial demand drivers you mentioned.
The solar, the green energy, the AI infrastructure.
Exactly. This isn't a speculative cycle. This super cycle, as they call it, is being driven by necessity. These technologies require silver.
Which means that consumption isn't likely to slow down.
Not anytime soon.
Right. So the report predicts a multi-year cycle driven by this sustained industrial consumption. And this raises an important question for you, the listener, to think about.
Okay.
If the price accelerates toward triple digits faster than people anticipate, if SLV really moves towards $90 or beyond by late 2026, what does that structurally high cost for an essential scarce commodity due to the speed and scale of all these technological rollouts?
A fascinating feedback loop to consider.
Could the commodity price itself become a bottleneck for the very infrastructure that's driving its own demand? If the material for the AI revolution and the solar boom becomes scarce and astronomically expensive, what happens then?
Something to think about as the market decides if $69 really is the new floor and $70.50 is that trigger. Thank you for helping us deep dive into these sources. We will be watching that technical confirmation very, very closely.